Retire on dividends and never worry about running out of money again. Most people spend decades saving only to stress over whether their nest egg will last. But Warren Buffett has cracked the code. His portfolio generates billions in passive income without selling a single stock. His strategy isn't just for the ultra-rich. Anyone can follow his blueprint to financial freedom. If you want to retire on dividends and live off your investments for life, here's exactly how Buffett does it, and how you can too. If you like videos like this, subscribe to the channel now and be the first to receive new videos we're preparing for you. Focus on dividend-growing companies. If you want to retire on dividends like Warren Buffett, choosing the right companies is crucial. Buffett doesn't just look for stocks that pay dividends, he focuses on businesses that grow their dividends year after year. Why? Because a company that consistently increases its dividend is likely financially strong, has a steady cash flow, and is committed to rewarding its shareholders. Take Coca-Cola, for example. Buffett first invested in the company in 1988, and since then its dividend has increased every single year. The result? Today, Berkshire Hathaway earns over $700 million annually just from Coca-Cola dividends, without selling a single share. That's the power of dividend growth. To build a portfolio like Buffett's, look for companies with a history of consistent dividend increases at least 10+ years. A low payout ratio, meaning they aren't paying out too much of their profits, leaving room for future increases. Strong financials, including stable revenue, low debt, and a competitive edge in their industry. These companies don't just provide income, they help your purchasing power keep up with inflation. A stock with a 3% yield today may be yielding 6% or more on your original investment in 10 to 15 years if its dividend keeps growing. That's why Buffett buys and holds forever. By focusing on dividend-growing companies, you ensure that your retirement income doesn't just stay the same, it grows over time. And that's the secret to financial security in retirement. Reinvest dividends. Early, withdraw later. One of the most powerful strategies Buffett uses to retire on dividends is reinvesting them, at least in the early years. Instead of spending his dividend income, he lets it buy more shares, which then generate even more dividends. Over time, this creates a compounding snowball effect that can turn a modest investment into a massive income stream. Here's a simple example. Suppose you invest $100,000 in a stock with a 4% dividend yield. In year one, you earn $4,000 in dividends. If you spend that money, your income stays the same. But if you reinvest it, buying more shares, your next dividend payment will be higher. Do this for 20 to 30 years, and your portfolio can produce tens or even hundreds of thousands of dollars in annual income without you adding another penny. Buffett's portfolio thrives on this principle. In the early stages, he reinvests dividends to maximize long-term growth. Then, once a portfolio is large enough, it produces more than enough income to fund retirement expenses. This strategy ensures that your dividend income grows over time rather than staying stagnant. If you're still working or don't need the income yet, reinvesting dividends is the smartest move you can make. The longer you allow them to compound, the stronger your financial foundation will be when you finally start withdrawing. When the time comes to retire, you can stop reinvesting and start living off your dividends without ever touching your principal investment. That's how Buffett ensures long-term financial security, and it's a strategy anyone can follow to retire on dividends successfully. Hold for the long term, don't trade. Buffett's investment philosophy is simple. Our favorite holding period is forever. He doesn't chase quick profits or try to time the market. Instead, he buys great companies, holds onto them, and lets time and dividends do the heavy lifting. If you want to retire on dividends, adopting this mindset is essential. Many investors make the mistake of jumping in and out of stocks, hoping to maximize short-term gains. But frequent trading comes with risks, market volatility, taxes, and missed compounding opportunities. Every time you sell a dividend-paying stock, you lose its future dividend payments and reset your compounding timeline. Buffett avoids this by holding on to strong businesses that generate reliable income year after year. For example, Berkshire Hathaway has held shares of Coca-Cola and American Express for over 30 years. These stocks not only pay dividends but have increased their payouts significantly over time. If Buffett had sold them early, he would have missed out on millions in dividend income. The key to this strategy is selecting high-quality companies, businesses that have a durable competitive advantage, a moat, stable earnings, and a long history of dividend growth. Once you've built a portfolio of such companies, the best thing you can do is stay invested. Long-term investing doesn't just reduce risk, it amplifies the power of dividends. The longer you hold, the more dividends you collect, and the larger your income stream grows. This is how Buffett ensures that his investments continue paying him indefinitely, making it possible to retire on dividends without worrying about market swings or economic downturns. Choose safe, high-quality dividend stocks. Not all dividend stocks are created equal. Many investors chase high dividend yields only to realize too late that the company is financially weak and may cut its payouts. Buffett avoids this mistake by focusing on safe, high-quality dividend stocks, companies with strong fundamentals that can sustain and grow their dividends over time. So, what does Buffett look for? A competitive moat. Buffett only invests in companies with a durable advantage. This could be a powerful brand, like Coca-Cola, a dominant market position, like Apple, or a unique business model that competitors can't easily replicate. A strong moat protects a company's profits, ensuring it can continue paying dividends for decades. Consistent earnings and cash flow. A company must have steady revenue and profit growth to support dividend payments. Buffett avoids businesses with unpredictable earnings, preferring companies that generate cash even during recessions. A history of dividend growth. Buffett doesn't just want dividends, he wants growing dividends. Companies that increase their payouts every year, like Johnson & Johnson and Procter & Gamble, signal financial strength and shareholder commitment. A sustainable payout ratio. A company paying out too much of its earnings as dividends may struggle to maintain those payouts in tough times. Buffett looks for businesses with a payout ratio typically below 60%, meaning they reinvest enough profits to continue growing. By selecting safe, high-quality dividend stocks, you reduce the risk of dividend cuts and ensure a reliable income stream. This approach is why Buffett's investments continue paying him year after year, allowing him to retire on dividends effortlessly. The same strategy can work for you. Just focus on companies with strong foundations and let time and dividends do the rest. Minimize taxes with smart strategies. Earning dividends is great, but keeping more of that income is even better. Buffett is a master at structuring his investments in a tax-efficient way, ensuring that he and Berkshire Hathaway pay as little tax as legally possible. If you want to retire on dividends and maximize your income, you need to adopt similar strategies. Here's how you can reduce taxes on your dividends. Use tax-advantaged accounts. Holding dividend stocks in accounts like a Roth IRA or 401k allows your investments to grow tax-free or tax-deferred. With a Roth IRA, your withdrawals in retirement won't be taxed at all, meaning you get to keep 100% of your dividend income. Prioritize qualified dividends. Not all dividends are taxed the same way. Qualified dividends from U.S. companies and certain foreign firms are taxed at a lower rate, 0%, 15%, or 20%, depending on your income. In contrast, ordinary dividends are taxed as regular income, which can be much higher. Investing in high-quality U.S. dividend stocks helps ensure you pay less in taxes. Hold dividend stocks for the long term. Selling stocks too often can trigger capital gains taxes, cutting into your profits. Buffett avoids this problem by buying and holding forever, reducing his tax burden. The longer you hold a stock, the more tax-efficient your portfolio becomes. Live off dividends, not capital gains. Many retirees sell investments to generate income, which can lead to significant capital gains taxes. Buffett's approach: live off the dividends alone without selling the principal. This keeps taxes lower while ensuring your investments continue growing. By using these tax-saving strategies, you can maximize your dividend income and keep more of your money working for you. The less you lose to taxes, the more secure your financial future will be. Just like Buffett's. Build a portfolio that covers your expenses. The ultimate goal of investing in dividends is to create a portfolio that generates enough income to cover your lifestyle, so you never have to rely on selling stocks or worrying about market swings. Buffett's approach proves that with the right strategy, you can retire on dividends and live off your investments indefinitely. Here's how to structure your portfolio for maximum income. Determine your target income. First, calculate how much you need annually to maintain your lifestyle. If you need $50,000 per year, for example, and your portfolio yields 4%, you'll need $1.25 million invested in dividend stocks. Diversify across reliable dividend stocks. Buffett doesn't put all his money in one stock. He spreads investments across stable, dividend-growing companies in different sectors, like consumer goods, Coca-Cola, financials, American Express, and healthcare, Johnson & Johnson. Diversification reduces risk and ensures a steady income even if one company struggles. Balance yield and growth. A high dividend yield isn't always better. Stocks with extremely high yields, above 7 to 8%, are often risky and may cut their dividends. Buffett focuses on stocks with moderate yields, 3 to 5%, but consistent dividend growth. This ensures rising income over time, keeping up with inflation. Prepare for inflation. Over a 20 or 30-year retirement, inflation can erode purchasing power. That's why Buffett chooses companies that increase dividends consistently, protecting his income from inflation. A stock yielding 3% today could yield 6 to 7% on your original investment in a decade if dividends keep growing. Stick to the plan. Once your portfolio is set, resist the urge to sell or chase hot stocks. The key to retiring on dividends is letting your investments work for you, collecting passive income while your capital remains intact. By building a strong dividend-generating portfolio, you create a financial safety net that provides lifelong income without the stress of running out of money. Buffett's strategy isn't just for billionaires, it's a simple, proven method that anyone can follow to achieve financial independence. Secure your future like Buffett. Warren Buffett has mastered the art of using dividends to generate passive income, and you can too. By choosing the right stocks, reinvesting early, holding for the long term, and managing taxes wisely, you can build a retirement portfolio that pays you for life. Don't rely on stock market speculation. Follow Buffett's proven path to financial freedom and truly retire on dividends. If you enjoyed the video, don't forget to subscribe to the channel. Click now on the video appearing on your screen and discover everything you need to know about retirement planning,